I'd like to ask the panel to start with what investors are actually looking for in relation to investing in infrastructure. Now, there's no shortage of infrastructure projects. It's estimated that there's a backlog of about another big figure, 700 billion, despite Australia being an attractive place to invest. So I might start with you, Martina. What are investors looking for when they're looking for quality investments?
Great, thanks Emma. I might just give you a bit of an overview, first of all, of the investment markets, talk a little bit about the characteristics of unlisted infrastructure, and then just give you an overview of how we look at it at QIC, and specifically some of the examples of some recent investments that we have made. So just in terms of the investment markets, most of you would be aware that we're in a very low yield environment. We've also got global growth, I guess, in a lot of jurisdictions quite anemic, particularly in Europe, and slowing growth in other regions. And investors have to look for returns, and particularly they're looking for yield. So what that's done is really pushed asset prices up in a lot of the listed markets, etc. So we're finding this trend of capital moving to unlisted private capital asset classes, and infrastructure has been one of the beneficiaries of that. And so when investors are coming to the unlisted infrastructure space, what are they looking for? Well, firstly, they're looking for yield, particularly when they're buying brownfield core, what we call core assets. They're looking for long-term stable returns, and they're looking to diversify away from economic and market cycles and volatility. And infrastructure assets have actually performed quite well post the GFC, and they've been reasonably resilient on a relative basis. So that's what investors are looking for. So at QIC, the approach that we take is we try and find assets that have those long-term stable cash flows. We are also looking for assets where we can add value and be active in the asset management. So we're looking for assets that we can actually grow or de-risk, and actually some of the areas that we're looking at is actually growing platforms of assets, and we're more about growing businesses. The other key thing for us is looking at what's happening globally, and the mega trends. And we've been doing quite a lot of work in the last couple of years around global mega trends and how they're affecting infrastructure assets. And we think that's a very prudent thing to do, in terms of our existing portfolio, but also about how we prioritise and how we look at investments going forward. And the global mega trends that we've been focused on, there's 5. Firstly, disruption as an enabler. Technology as a disruptor and as an enabler, and particularly there, if you look at what's going on in the energy space around smart grids, battery storage, etc. Secondly, urbanisation. Australia's got a highly dense, city population, and that's going. Our cities are growing, and that's going to get bigger. And so, how do we look at water and energy security in that environment? Thirdly, we heard from the treasurers, some of the states in Australia are doing really well, but just generally, the states have some fiscal constraints in various countries. So particularly with another trend, which is ageing demographics, and so therefore health costs are going up. So governments want to provide infrastructure, so they need to partner with the private sector, and so that's an important thematic. The fourth one is around what we call the Silk Road. So, Australia's fantastically positioned. We've heard a little bit about it today in Asia, both from a trade perspective, but also we've got an enormous consumer base, with a growing middle class. So that's an area that we're keenly looking at. Which one have I think I've got all of them. Oh, sorry, the last one is more from less. So with, obviously growing population in the world, we're at 7, going to 10 billion. We've actually got finite water, energy, and climate change issues. So that's another area that we need to think about in terms of how we invest. So we've taken all these mega trends and the investment characteristics, and we've thought about, well, what are the assets that we've actually targeted and we like. And someone I was having lunch with said to me, oh, you know, QIC's been very aggressive lately, and you know, and buying a lot of investments. And we have invested, you know, about 3.9 billion in equity in the last 12 months. But, you know, I guess what people don't see is that we've been working on these things for years. You know, they actually take a really long time for these opportunities to come together. If I just talk about the three assets, have I got time, or should I hand over to...
No, you go. That's
okay.
Fine. We've got plenty of time for that.
Okay. So there's three investments that we've made in the last 12 months, and they're all very different, and I think they all display a certain level of innovation of approach and, you know, different sources of finding investment opportunities. The first is the Iona gas storage facility in Victoria. And what we liked about that asset was the fact it provides, you know, gas security in the southeastern part of Australia to about, you know, 66% of Australia's population. And the way that we've approached that asset is we put in place long-term contracts which effectively give us that, you know, stable long-term cash flow for our investors. The second investment that we made, you know, I think was very innovative in terms of the approach, is the renewable partnership that we have with AGL, and that is quite an innovative approach in terms of how to look at building, you know, renewables in partnership with AGL. So what we've done there is we have, you know, we're building 1,000 megawatts of renewable energy. We've committed, you know, $3 billion in total has been committed to that fund, and $1 billion of equity. And we have, you know, two initial sort of solar investments going into that at the moment, and then we've identified two wind developments for the future. So that's, once again, we have, you know, greenfield development in partnership, and also we've got long-term contracts in place, so we've got some certainty around the revenue streams from that asset. And the third investment that we've recently been fortunate to be successful on is the privatisation of the Port of Melbourne. So we were part of the successful consortium for that asset. And I mean, that's a you know, fantastic asset that has, it's obviously a key sort of strategic asset in the logistics chain, you know, for Australia and Victoria to sort of promote trade, which is one of the thematics that we're looking at. And the other thing that we really like about that asset is, you know, there's good economic fundamentals, and what that allows us to do is the asset's going to grow over time, so we can continue to invest capital. So just some examples.
Thanks, that's great. Mark, I might throw to you. Everybody's talking about what super funds are looking for and how we can attract more investment from funds. What makes an investment attractive?
So we've been investing in infrastructure for a long time, and it's been a really good investment. It's probably been the best long-term returner in the portfolio over 20 years. So absolutely outstanding. So, and those assets, the toll roads, the airports and the ports have made lots of money for members. So they've been fantastic investments. So if we think about a total portfolio, a total balance plan, someone's got a whole superannuation portfolio, infrastructure makes up, in our world, about 10% of that. So Australian Super's got $100 billion, $10 billion roughly is in infrastructure. So it's not everything, but it makes up a pretty meaningful amount in the portfolio. And in that 10%, we're looking for assets which have got income, stable cash flows, as you mentioned, growth, and a stable competitive position. Not much different in some ways to what you look when you try and buy a big shopping centre or something like that. But when you allocate capital to infrastructure, it's really a function of what else can you do with the money. Because we've got a whole portfolio, $100 billion, and infrastructure has to be competitive in its returns. And as mentioned before, in the current environment, infrastructure is very keenly sought. You'd almost say there's a deluge of global capital looking for infrastructure deals. So we talk about the shortage of capital. Us as investors actually think it's the other way around. There's a deluge of global capital. From traditional investors like fund managers and ourselves, global pension plans are moving into infrastructure. Sovereign wealth funds all around the world are moving into infrastructure and using Australian fund managers to do it. And there's a variety of other investors, corporates as well, particularly out of China, looking to buy infrastructure. So as far as I can see, there's absolutely no shortage of capital. There's absolutely completely the reverse. There's a deluge of capital pushing up prices. I know it's not the public debate, but that's certainly what we see at the coalface.
No, that's great. And just picking up on that point, if there's the deluge of capital, and then it's knowing where to put that capital. So, Philip, I might ask you, one of the comments that's often made is from the private sector, we want a clear pipeline of projects. We want to know when projects are coming so we can invest the deluge. What's Infrastructure Australia's role in managing that pipeline, and more generally, what have Infrastructure Australia been doing more recently?
Thanks, Emma, and thanks to Malcolm and Martina for outlining my challenge for me. In terms of, I'd like to say a couple of things. First and foremost, what I think you're looking for fundamentally good investments and good projects, and part of our role is to help bring that together at a national level. But what we found over the last 18 months is an environment where, to some extent, we moved away from long-term planning. We'd moved away from really investing the money in developing business cases and preparing those good projects for you to invest in. And so, pretty much for the last 18 months, a big part of what we've been doing in Infrastructure Australia is working closely with the state and territory governments, particularly where I-bodies exist, as we call them, so infrastructure bodies. So that's Queensland, Victoria now, New South Wales and Tasmania. So working closely with the state and territory governments to develop, number one, an evidence base of, what is the problem we're trying to solve over the next 15 or so years, and then to respond to that evidence base with two things. One, a list of projects, which we released back in February, which I think at the time when we released it, there were 93 initiatives and projects on the list, which we call the infrastructure priority list. The fact there were only 2 projects on the list was of great surprise to many people, but I think that evidenced the fact we'd moved away from, as a nation, moved away from that kind of longer term planning and investing in the business cases. So that was one deliverable. The other was largely a policy reform document where we looked at some of the harder reforms that we need to address over the next 15 years, particularly around the planning and the need to have better integrated planning, particularly integrated with land use planning. So we talk about that a lot, but it's still a big challenge for us as a nation. We looked at the governance, what's the right governance to bring together different levels of government to shape this planning. But then also some of the challenges of delivery, of engaging with the community, particularly the business community. So we've outlined a number of 78 recommendations in the plan, a number of reforms, which we'll no doubt come back to in the rest of the panel. And then finally, just to close out on the priority list, pleased to say that since February, our board has looked at 14 business cases, which are now, as of last Friday, when we put another 4 on the priority list. So we've now got a much healthier situation at a national level in terms of projects that have been assessed are ready to go. So I think that, and long may that continue. So I think we've reinvigorated that planning process to some extent. There's still work to do. We've got a healthier priority list. So I think we're moving to the point where we have strong evidence-based projects which are ready for the investment community to have a look at. But the principle, one of the flavours of this panel is around funding, and I think, as we said in our plan, the principal issue is not the financing. There is a deluge of finance available around the world looking for good assets, but actually the bigger problem for us is one of how do we fund these projects ultimately.
Yep. So just picking up on that point about how we fund these projects and the topic of the day, which is innovation, how do we be more innovative about funding these projects? Mark, I might go to you first and then to Phil. ideas like value capture we hear a lot about, user charging, those initiatives, are they what you see as innovative funding models that we should be using?
I think we've got it pretty right now after a long time of trying to work out what to do. I think there's three types of infrastructure. There's infrastructure businesses or things which are commercial now. And so they generate commercial returns and they'll have no problems attracting private capital. You know, that might be an airport, a power utility or something like that. But things which are commercial businesses now will have no problems getting finance. The second category is things which are commercial in the future. You know, the cash flow might become positive in 10 years' time or 15 years' time, and you're building a piece of infrastructure for 60 or 70 years for the nation. Well, then that's more problematic for commercial investors because who's going to take the risk of 10 years of cash flow to be sure it's really going to work? So that's naturally a spot where the government can step in, and this recycling of capital they're doing now is I think, the most significant initiative regarding that. And the third category is what I call social infrastructure. You know, schools, hospitals and whatever. They're never going to be commercial. All what's really happening is that the government is paying for someone to build and run them. And so that's just a matter of the appetite of the government to write a cheque big enough to get the people to do it. But there's only three things, but the commercial ones have got no problems in funding. And so what we're really talking about is trying to find a way to get one of these second and third categories up. And if I was the government for the second category, which is by far the largest, which is this commercial in the future, I'll fund myself and then sell once the cash flows are stable. That's by far the best for the nation, rather than funding with expensive commercial capital at the outset.
So we've heard a bit about value capture being used as a way to deal with those projects that might be commercial in the future, for example, high-speed rail. Do you have a comment on that?
Look, you're asking for someone to write a really large cheque for positive cash flows in 15 years' time or something, which may never be positive. It's just something we'll demand a very high price to put our money on the line for. I remember once looking at the Alice Springs to Darwin Railway or something, and someone said, they brought it in, and I said, oh, we don't like this, we've looked at this before. And I asked them the question, I said, when is it going to be cash flow positive? And they went to their spreadsheet, he said, in 22 years' time. Well, that's why it wasn't funded, because 22 years' time is a lifetime. So I just think it's very hard to make something which is uncommercial for a long time commercial, and you end up paying a lot of money to get rid of a risk which you should take on government balance sheet.
Sure. Phil, do you want to comment on that and on the role of Infrastructure Australia in promoting innovation and innovative solutions?
Yeah, so just going back to the question around road user charging and value capture. So, when we published our plan back in February, we spoke to try and simplify the conversation around, really there's only two ways to fund infrastructure, one through user charges, the other through tax. In terms of road user charging, it's clear that the system we've got in terms of roads is broken, and one of the other recommendations in our plan was to call for an inquiry into road user charging, recognising that this could take at least the 10 to 15 years of the plan to understand. And really the first step in that discussion is to have the discussion with the community around what the problem is that we're trying to solve and what the options are to solve that. So we're very clear around the need for an inquiry there. In terms of value capture, that's another area we've been having another look at, and I think I'll probably fall into the trap now of using the most used example, which is Crossrail in London, which actually kind of now moved from being sick of hearing about it to now using it myself as an example. But I'll use it as an example because it's quite useful to illustrate a number of points. And one is that that was a project that was well planned, in fact, planned to death over 40 years. And actually the issue was the funding, how do we pay for this? And I think because it had been well planned, it was well communicated to the community, and most particularly to the business community, who in the end got sick of hearing about it and came to the party and said, well, when are we going to see this project? Because actually we can see the benefits this will bring to our business. And I think that was really a turning point for that project, which then actually led on to the opportunity to have value capture. And I think the bit that's misrepresented is how much value capture contributed to the project.
Yes.
But, you know, it was, in rough terms, about a third of the cost of the infrastructure was paid for by value capture, which was largely so here's where the circle closes, was largely a business levy on those very businesses who were asking for it. So on the one hand, they'd been sold, the other hand, they'd asked for it, and then they were reasonably willing to put their hand in their pocket to make a contribution to the project. So I think, you know, there is, you know, as we said in our 15-year plan, there is a role for value capture here. It's not a magic pudding. It's, but it's you know, it could make the difference between some projects, good projects, getting up or not, and it's something we should be routinely considering. But it's certainly not the answer to everything. You know, fundamentally, there's only two ways to pay. One is through tax, or the other is through user charge.
I want to move on now to a point that's been raised by the Treasurers and a number of other panellists, and Philip, you raised it yourself, about community and bringing the community voice into decisions about infrastructure. Martina, what role do you think the community's got to play in shaping how we make decisions about where to invest in infrastructure, and how do we better engage the community?
I think I think that's got to be actually more of a focus for infrastructure investors. At the end of the day, it's all about a service that you're providing. So you've actually got to make sure that that the customers want it. And I think, you know, particularly when we're looking at priority lists, etc., I think it's important to say, well, what are the top, I guess, you know, projects that the community would actually like to see. I think with firstly with technology. You know, customers now have more choice, and that's going to increasingly be the case in the infrastructure sector. And so there is sort of quite an onus on higher standards. When we're operating, you know, certain businesses, and if I give an example, both Mark and I are invested in this asset, which is Brisbane Airport. You know, we've got to think about building for the future. So we built, you know, roads ahead of the demand being there for a better customer service. We also are now in the process of building, you know, a $1.5 billion runway. It's the largest privately sort of funded runway in the world. You know, it's a 100-year asset, and you've got to take a very long-term view in terms of how you finance that, and you've actually got to work quite creatively with the customers, in that case being principally, you know, the airlines on behalf of the passengers, to come up with a commercial structure that allows you to go and start spending, you know, $1.5 billion of, you know, pension, capital, etc., of your clients' money. So I think we do need to have a strong understanding of what the consumers want. I think the other thing that's really important is, you know, asset recycling has been, I think, a success, and I think it's important that we continue to have the social licence from the community to engage in asset recycling, and particularly for assets that are very, you know, high profile. You know, we need to continue to have sort of open, you know, transparent processes around how those assets are sold. So I definitely believe in a greater focus on the customers.
Mark, I saw you nodding away during that. Did you want to add anything to that?
Yeah, well, a lot of these assets we call infrastructure assets were previously owned by the taxpayers, by the public, and they see them as their assets. And so they're naturally, as anybody would be, quite protective of them and what happens to them, and don't want to see their assets sold away to fund frivolous policies or the like. So it's important that the assets are sold, that the money is really well used, so that people can see there's value from what they're doing when they're selling one of their assets. They're getting something better in return. And secondly, the owners of the assets can't take advantage of the people who are the users of the assets in a way which is socially unacceptable. Otherwise, the licence to operate, as you mentioned, will disappear. So we like to think of some of these assets as being almost like social privatisation, whereby they're formerly on the government and now they're owned by the Australian Super's got 2 million members, by 2 million superannuation members. The same people in effect are running the asset, just through a different form. But to really convert them into a hard-nosed, maximise making money out of people in the short term, I just don't think is socially sustainable.
Thank you. Philip, did you want to comment on the role of Infrastructure Australia in the concepts like asset recycling, not to diminish the community generally, but they're not things that people talk about every day, and different ways of funding infrastructure are not things that people talk about every day. Is there a role for Infrastructure Australia in educating the community and bringing community stakeholders along?
Yeah, I think, yes, there is, and I'd like to think at least since February when we relaunched the priority list, we've played a role in that in terms of what we publish on our website. So those 93 projects and initiatives that I mentioned are outlined at a fairly high level on the website. So I think that provides, probably for the first time, a comprehensive list of some of the problems we're trying to solve, which the community can access, business can access, and many of those are now evolving through to full business cases, and there'll be a lot more detail around those projects available. And certainly through our assessments, we make those available as well. So I think there is a greater degree of transparency around what the problems are, what the potential solutions are. I think in terms of asset recycling, again, in our 15-year plan, that was something we saw as a means of completing some markets, which is positive. I think that the one part of the jigsaw that was touched on earlier was around better use, and I think again, we made a comment when we published our audit in May of last year that we've probably got most of the infrastructure that we need. It's rather about how we use it. And certainly we're seeing a far greater focus now on getting better use out of existing infrastructure, and indeed seeing some investments coming forward for that, which hasn't really been so prominent in the past. So I think that's a good thing, and I think that in itself sends a strong message to the community, including the business community, that we're not just continuing to build, which obviously we still need to do, but we're also focusing on making better use of what we've already got. And I think the last thing I'll say on that, just to close the loop back with this morning, which was fascinating, I think the whole innovation piece and adapting to technology and the greater use of data, then obviously it's fundamentally all this infrastructure is supporting services, and we've got to keep our eye on that this is supplying customers with what they want, and then of course within our markets we need the regulation to be keeping pace with that technological change as well. So it's important that we keep an eye on that.
Do you think the regulation is keeping pace?
Not in all cases, I'd say. I think that's hard, but that's certainly an area we need to focus on.
And is that going to become more of a problem, as we heard this morning, with the pace of technology and the pace of change, the gap between regulation and where we're going with these projects, whether it's better use of old infrastructure or new infrastructure, is going to become more of a problem, potentially?
Well, it'll only become a problem if no one responds to it, which I'm sure won't be the case. So
it's another challenge.
Yeah, it's just another challenge.
Thank you. Now I might throw to the audience now so that I keep on time for afternoon tea. There are roving mics, and as with all the other sessions today, if you have a question for the panel, can you please introduce yourself and keep the question brief? Any questions? We've got one over here.
It's Catherine, and Phil, I couldn't help but just extend on your last comment there. So, Martina, you spoke about investment into obviously renewables, which is new energy economy, and we talk about innovation in investment. I suppose what I'm trying to get an understanding of is through your work, where do you see smart infrastructure? So let's just think about the fact that we're potentially going to be having connected vehicle corridors that will be managing freight networks through the country. Is there sort of some views around planning or thinking about smart infrastructure? And what are your views on where we see the likelihood of investment being in not just the physical but also the digital smart infrastructure piece?
We've been looking at it in terms of our existing businesses and how we can actually enhance and improve things within those businesses. So if I take an example, just to and this is only a little thing, but it actually made quite a big difference in the US. We actually have a concession over the Ohio State University car park, which is 37,000 car spots. It's a big university campus. And what we did there was, when we actually were sort of a 50-year concession, when we were gained ownership, we actually introduced a whole lot of app technology on people's smartphones around, finding spots. And what that meant was that these people had a better customer experience. They could find a spot more quickly. But also what it did was it actually freed up the roads. Mm-hmm. So the university itself could actually optimise the capacity of that road network. So that's just one example. I think another area that we're looking at is obviously with what's happening with, the Internet of Things and data. And obviously that's an area with a lot of potential when we look at sort of, on a forward basis. So that's another area that we're currently doing some work around, what are the investment opportunities from our point of view. When we look further forward, things like autonomous vehicles, we've done some work on that. I mean, it's something for the future, and we're thinking about, well, how does that affect, for example, our existing road infrastructure assets? And, it's not something that we're looking to put in place. I think it's something where we're going to have to work with governments to work out, how those all the technology that's needed to facilitate that actually gets put into the road network. And particularly when you look at sort of urbanisation and the concentration of people, connectivity, technology, and all those things actually assume more importance. So how do governments think about that and plan for the long term? And then how do we as infrastructure investors, help in and which investments do we actually pick to invest in?
Any other questions?
Rod Maddock, Australian Centre for Financial Studies and CEDA. My question really is to Mark. Mark, you gave us a little bit of insight as to the basic asset allocation principles you're using. Roughly 10% of a long-term portfolio should be in infrastructure. Can you drive it down a little bit lower and just tell us how much should be in greenfield and how much in brownfield? Some of those sorts of issues?
Just on the 10, if you're an individual, you could have more than that.
Depending
How young you are and what your appetite is for illiquidity, because you can't go and sell a share of a toll road because you want to buy a new car or something else. Generally, we don't do many greenfields for things I talked about because they struggle to cut the mustard with regard to stable cash flows. So they don't really meet the stable cash flow and yield criteria. And so I think most pension plans or superannuation funds would only have maybe one or two. If they've got 10, no more than 10% of that 10 would be in greenfields. It's almost all in brownfields. And I think globally for investors, that's pretty much the same story.
Yeah, that's certainly the case for us. We have about 10% of our infrastructure portfolio sort of allocated to greenfields. But I think I might just add one thing. I think with just with greenfield investments, because they're really the most challenging. There's a deluge of capital for brownfield, and I think it's where the greenfield assets, where the things on the list are the things where it's more challenging to actually get the capital. And so that's where we actually do need to innovate and work very closely, the private sector with government. And if I just another example, the North Connects project in New South Wales, that was, we're part of the shareholder group for that asset, and that was actually, we had the M7 toll road, and what we did there was we worked under the unsolicited proposal process with the New South Wales government, and it was sort of value capture in a different form, because what they did was we changed the M7 concession. We got an extra 10 years and we were allowed to increase the truck toll. So all that value that was created by changing that existing concession was then used to build a greenfield asset. So I think we need to do more of, collaborating, engaging, working out how to come up with solutions. And I think, we've got a very sophisticated market in Australia of institutions that have invested in infrastructure for a long time.
I might just add to that really reinforces the importance of having a list and having a future side of what the potential investments are. I think then you can step back from it and have a more sophisticated conversation. Well, yeah, these are the things we want. Obviously, we have to prioritise them, but where's the innovation in terms of funding? Because some things on the list inevitably will be hard to fund other than through traditional taxpayer means.
Wonderful. Now, I'm sorry to cut the conversation short. I know there's probably a lot of other questions out there, but you can feel free to ask the panellists, I'm sure, over afternoon tea or over dinner tonight. So all it remains for me to do is thank the panel very much. They've done a fantastic job today of covering a range of issues, tied them in beautifully to the themes that we've been talking about in terms of innovation and really focusing us on the importance of the infrastructure agenda. So please join me in thanking each of our panellists.